Hello everyone and welcome back to That Investing channel. Today I thought I'd be doing a full valuation focused video on fair values for all of the companies in my portfolio. The likes of Amazon, Google, Salesforce and Hims and Hers are all positions I have good returns on. But are they buys today? Let's find out. I invest in individual companies in my £55,000 stocks and shares I hold on Trading 212. These companies tend to be monopolistic and have a distinct competitive advantage, and all are growing their free cash flows faster than the market. If you get something out of this video, then don't forget to leave a like and consider subscribing to the channel to help it grow. So let's kick it off with my largest holding, and that is of course Amazon. Now I have 74 shares in Amazon and it's about £13,800 position. It's up by about £3,600 or around 34 to 35%. And its overall weighting as part of this portfolio is sitting at about 25%. But is it really a buy now? So for the likes of Amazon, I like to use a DCF calculator, what we're going to be using today, and the operating cash flow specifically because it is a high capex intensive business. And the number of years that I would do is around 5 because after that I believe the prediction is quite uncertain. The metric growth rate I've given Amazon, when I did my analysis a couple of months ago, was 12%. My main reason for that was because it was half the annual operating cash flow growth rate in the past 5 years at 24%, and it gives suitable margin of safety on the growth rate. I allowed for a slight dilution of shares and the price ratio sitting around 20. Now, obviously, these are conservative estimates, and we get a fair value around $226, or around a CAGR, the market average of 9%. With the share price that now sits at $233, this would be rated a hold based off this sort of analysis. However, personally, I do believe that this conservative growth rate for Amazon could be changed slightly. If we just give a slightly different metric of growth rate and price to operating cash flow, which is still under the 5-year averages and still appropriate for Amazon, then we get a fair value of $259 and a CAGR of 12%. And personally, I don't believe this is a bad growth rate for Amazon. So for me, this growth rate is actually still pretty good. I don't believe it's as conservative as the other one, but I don't believe that we are getting away from what Amazon could actually accomplish in the next 5 years or above that. So I still believe that Amazon is probably a buy in the current market. It's still going to deliver a market beating return even at these share prices. And even though I'm not adding to my current shares, I do believe it's a buy right now. Now we have my second largest holding, which is Brookfield Corporation. I have 216 shares at a value of over £10,000 now, and we're up by about £1,700 in the position, or around 19%. And in terms of weighting, it actually takes up around 18% of the overall portfolio. Now, Brookfield Corporation is more of a complicated one. We can't use their free cash flow numbers because they fluctuate considerably for the nature of the business. They automatically reinvest those cash flows before they get onto a balance sheet. But we would use their distributable earnings, which is the number we've got down here, around $5 billion for the next 5 years. And in terms of their growth rate, they've said they'll grow that between 22 to 27% over the next 5 years, which is very good growth on free cash flow, or distributable earnings in this case. They have been buying back some of their shares, so I've allowed for a slight buying back of shares. And I've allowed for a price ratio that is well below what they currently sit at, which is around 17 to 19 times price to free cash flow, or distributable earnings. And in this case, we've given a metric of 15. In that particular case, even then with the metric of contraction there, we still get a fair value around $81 and a CAGR of about 17% from the current share price. And that is why I was buying Brookfield around this sort of mark on the 6th of January, around $55. And I actually added about £1,000 to this company. And I still believe that this company is a good buy at its current share price. Then we have Visa, which is my third largest holding at 34 shares and a value just sitting over £9,600. It's up by about £2,500 or around 35% right now. And it's actually one that's done very well in the past year, massively recovering from a bit of a dip that it went on when I was buying into the company. And this is one I would probably rate as a hold right now, and there's a bit of a reason for that. Visa is a very predictable business model and has predictable growth in free cash flow, but it is slowly slowing down. We see the annual free cash flow growth rate over the past 5 years sits at 10%. So I've given it a conservative growth rate of about 8% over the next 5 years. This is allowing with their shares buybacks that they've been doing around below 2%, which is very good. And they have a growth rate that sits over 14% in terms of their dividend. In terms of their price ratio, obviously, as with it being a mature business, I've gone for a slightly lower price ratio than they currently sit at of 31, which is their 5-year average. And if we give that 28 price ratio, we get a fair value sitting at $309 and a CAGR over the next 5 years around 7%, which is below at the market average. And their share price at the moment sits at $351. I'm not really buying into this company now. I do believe it's getting more on the more expensive side. I still believe that Visa's an excellent business model. That doesn't change anything about what I believe about the company, which is really good. It's highly predictable, and that free cash flow growth rate with those shares being bought back is excellent for a business. But they're on the more mature side, and their growth rate for free cash flow is slowing down. So we've got to allow for that a little bit, and I've tried to do that with this valuation here. Now, I do believe you have to pay a premium a bit for the likes of Visa and MasterCard, so that has to maybe be factored in. But on this particular metric and these sort of growth rates, I do believe Visa is a hold. We have a company that's on a bit of a dip right now, and that's Google at £5,500, up by about 14% or £700. It's now dipping back to the 180s, and its current weighting sits around about 10% of the portfolio. Google's one that I would have liked to have used the free cash flow for. However, their price to earnings is something that I believe is more appropriate for trying to identify their intrinsic value right now, mainly due to their capital expenditure. If we give a 5-year analysis and a growth rate that is conservative on the 13% side, with their 5-year average being 23% in price to earnings. Then we've got a shares outstanding reduced by about 2%, a dividend growth rate sitting at 15%, and a price ratio that sits below their 5-year average at 20. And we get a fair value of $213 per share and a CAGR of about 12%, which is a market-beating return. Now, if we're using free cash flow numbers, this company would not be a buy. So it does depend on which metric you want to apply a certain margin of safety to. But I would be sort of remiss if I didn't say that I wouldn't be buying this sort of valuation right now, if I'm honest, for Google. My main reason is because I've got other possible opportunities in the market that I think are better. So even though this fair value here would identify it as a buy right now, personally I want to see it drop below 180 before I contribute more money to this particular aspect of my portfolio. So it's a hold right now, bordering on a buy for me. In terms of weighting, we have Salesforce. I have 20 shares over a value of £5,200 now. It's up by about £1,300 or around 34%. And I've chose to hold on to the small remainder of my Salesforce, even though I sold about 10 shares and trimmed it around the $341 mark. So this company is actually a bit of a hold for me, and the metric and DCF doesn't actually back that up. So you can see here we've predicted the free cash flow over the next 5 years for CRM or Salesforce. They've had an annual free cash flow growth rate that sits at 28%, so over half of what we've actually allowed for here, and we've allowed for a slight dilution of shares with a dividend growth rate around 10%, which is below what they currently do. Their price ratio I've given as 26. Their average price to free cash flow is actually a lot higher than that at 36. The reason I've done these more conservative estimates is because I believe that Salesforce will might likely slow down in terms of its free cash flow growth. I could be wrong in that, but that's my own assessment of the business. In terms of those metrics, though, we still get a fair value of $357 and a CAGR of about 12% over the next 5 years, with the share price currently sitting at $327. So it would still be a buy on this DCF, even if we maybe wanted to apply a bit of a margin of safety to it. For me personally, I believe there's other opportunities that I am more focused on. Next, in terms of weighting, we have about a 6% position in MELI or Mercado Libre, which is the e-commerce giant in South America. I have 2 shares, an overall value of £3,281, and our overall return has been about 24% or around £646. This is one that's actually recovered considerably over the past month from its lows of about $1,700. I'm going to use free cash flow for this business as I believe it's most appropriate, even though it could be slightly inflated due to the nature of their business. And the number of years projected is about 5 years, with a growth rate about 15%, which is on the massive conservative side given their 5-year average. Shares outstanding growing slightly, and a price ratio of 20 compared to their average price to free cash flow. Even with these massively conservative estimates, we still get a fair value that is well above the share price at $2,989 and a CAGR of about 18%. With the share price sitting around $2,000, this is still a good buying opportunity in my opinion. Unless we have one that I would prefer a higher weighting to, as it only sits around 5%. And that's S&P Global, the ratings and analytics company. S&P Global sits around about £2,900 now. We're up by about £580 or around 24% on the current position. But is it a buy now? I'd rate this one a hold based off the current DCF that we've done here. Its free cash flow growth rate we've given a conservative 13%. We've allowed for a slight dilution of shares, which is actually lower than their 5-year average of 4.79%. And their dividend growth is sitting over 10% with a price ratio of 28 compared to their 5-year average of 32. All that considered, we get a fair value of $495 per share and a CAGR of about 9%. With the share price currently sitting at $515, this is obviously above the fair value with no margin of safety. My second smallest holding, which is Texas Roadhouse, we're up by about £2,500 and his overall return has been about 51% or around £863. It's now sitting on a bit of a dip. On the past 3 months, down about 10%, so it could be a good buy right now. Personally, I'd rate this one as a hold, mainly because I've been conservative in my estimates in free cash flow growth. Free cash flow over the next 5 years, I said, will grow around 10%, which is well below their 5-year average. Slight buyback of shares and a dividend growth rate sitting over 15%. And a price ratio that sits closer to 30 rather than their 5-year average of 34. Which gives a fair value of $170 and a CAGR of about 9.57%, which is in line with the market and around their current share price. Then we get to my now best performer in the portfolio, which is ironic because it's the smallest position. Isn't it funny how that always happens? And then we have Hims and Hers, which is a very small percent of the portfolio, about 3% now, just over that. We have 51 shares at a value of over £1,856. And it's up by about 67%, and we've only owned it for about a month. So we're sitting now, and it's actually, the last month is up 75%, which is just huge. So you could look at this sort of growth and consider, well, it must be overvalued. Well, I don't really think so. I think there's still a very good argument for this company being undervalued and a buy now. Their numbers for the next 5 years I've put as a metric growth rate of 18%, which I think is massively conservative. I do believe they can accomplish well over 20% metric growth rate for free cash flow. Their shares outstanding I would put more as 1% because obviously their annual shares outstanding has grown considerably. That's mainly due to stock-based compensation that is no longer happening. And then a price ratio of 24 times, which is an expansion over the next 5 years, which is their 5-year average of 21. As I do believe this is a more appropriate metric for a company that's growing its free cash flows around 77% CAGR over the past year or so. Sort of thing. So I really think this company's growing very fast, so it's hard to predict. So I would go on the conservative side when something like that. Then we get a fair value of $50, around 12.75% from the current share price of $44 and a CAGR of about 12.67%, which would arguably put it as a buy. If we wanted to be less conservative, we could go for a growth rate around 22% and still have that price ratio, and the share price could CAGR over the next 16% over the next 5 years. So it depends how conservative you want to be. Personally, I would always be on the more conservative side, but I do not believe that this share price is that bad for HIMS. For me, I think HIMS is still a buy despite its current run up. I still believe that the fundamentals are still increasing quicker than the share price is going up, even with a 70% gain over the past month, which is just massive really. And in terms of its actual position now, I do believe that it's a volatile stock. So I could see this one going straight back down after all this sort of massive hype around the Super Bowl ads and stuff like that they've recently done. So I think that it's a business that's doing marketing very well, but people are sensationalist about the stock. It jumps up, it goes way down, we get like a 30% drawdown. So I could see this one going on a considerable dip maybe after this sort of period, and that would be a great buying opportunity in my opinion, and I'd probably look to add to my position around the $30 mark. But that's just me. That doesn't mean it's not a buy now, and I still believe that the fundamentals are increasing quicker than the share price. So that's about it. In terms of overall sort of summary, I would say that Amazon is looking at slightly undervalued to fair valued right now. Brookfield Corporation is looking undervalued and a buy. Visa is looking like a hold to me. Google or Alphabet is actually currently a little bit of a hold for me, but you could argue it's a good buying opportunity as well. Salesforce is arguably a good buying opportunity, but it's a hold for me personally. Mercado Libre, I think, is a good buy right now and is very good in terms of its fundamental growth CAGR for the next 5 years. S&P Global, I believe, is a hold right now, but I would like to add to it in the future. Texas Roadhouse is a hold right now, and I believe it's hold in general until we see a bit of a drop on the current share price. And then HIMS and Hers, I think, is still a buy despite being up over 70% in the past month. But that's just me. Please do your own research before looking to buy into any particular of these holdings, as I do believe that you need to have conviction in your own stocks. Thanks for watching. I appreciate it, and I'll catch you in the next one.